It's having a little pullback, nothing significant. It's just drifting sideways as we talked about yesterday, trying to stay above the 5-day moving average. So this is a healthy pause. If we look at the 30-minute chart, you can see here it's at a pop, a pause, a pop, a pause. 5-day moving average is kind of meandering its way up here, usually acting as kind of invisible support. And that's kind of down at the level we're at today. So we'll see if gold can find some support. Silver down 5%. Again, it is starting to get a lot of attention. It's getting a lot of volatility, big waves of buying, big waves of profit taking. And that's part of this phase. That's what happens in a bubble. Let's take a look at the charts today. So quick off, we've got the equities market trading slightly higher. We got the S&P 500 up 0.2%. We've got the NASDAQ up 0.5%. We've dipped into these oversold territories a couple times. The market keeps bouncing and moving, and yesterday it digested a big gap up, and we saw a good fade back down, filling most of the gap. Now, as long as there's not a big gap, I consider it to be filled. So it's obviously it's not a perfect gap fill, but really you just need to fill most of it. If we look at the QQQ, we can see the QQQ filled most of it as well. If we zoom in, we had this big gap up, and then the market faded down to the 20-day, which is this pink line, and filled most of the gap. So yesterday's price action, that gap and fade, because it gapped into resistance, it was very to be expected. And when we look at the daily chart, obviously we've got the NASDAQ here trading sideways with the S&P 500 primed and ready for a big move. And the big question is which way. The underlying trend is still pointing to higher pricing. Now, let's take a look over at a few of the members' questions and what we want to touch on. Money is flowing out of gold and silver this morning. We got gold down 0.5%, silver down 4.5%. So lots of volatility in this space. But let's take a look over at XLU first. XLU up 1% yesterday. A member was asking, is it breaking out? Is it starting a new uptrend? And it might be. It just might be have carved in a bottom. This is a bottoming style formation. This is 3 surges to a low and a sharp reversal. And a sharp reversal, usually you break a significant pivot high. You get above the moving averages. The first pause or pullback can usually be a buying opportunity, and then it can start to go higher. You can see there was a reversal here, a strong pop, pullback. Moving averages all started to slope up, and then it took off. So we might be starting to see money move into this defensive sector and start to come to life. It's definitely had a very nice big run. It's had if you look at this as the overall uptrend, and this is the bull flag, it's had an A, B, C move with bottoming type of formation. It keeps poking to a low, a nominal new low, another nominal new low. Each of these lows just creates a lot of fear and people give up, and it shakes out the longs, and then boom, it takes off without them, and it could start another big leg higher. So we might start to see the utility space start to outperform the S&P 500.
One of the most notable developments is the renewed strength in traditionally defensive sectors. Utilities, long overlooked, are beginning to form classic bottoming patterns. These formations often emerge after prolonged weakness, marked by repeated attempts lower followed by increasingly strong rebounds. As key moving averages turn upward, early pullbacks frequently become entry points for longer-term investors. When defensive assets start to outperform broad indexes, it often reflects subtle shifts in risk appetite. Capital doesn't flee markets all at once. It rotates quietly. This early rotation suggests that some investors are positioning cautiously, preparing for potential volatility ahead rather than chasing aggressive growth.
Another question we had was the RSI on gold and silver. Does this affect the price outlook? Now, I don't follow RSI anymore. The way I used to, RSI I look at is like flexing your arm, the muscle. When the RSI line crosses above that 70 or 80 upper band, that upper level, when it's above that level, it should be, it's flexing its muscle. It's strong. You want the RSI in the upper zone. A lot of people trade it completely backwards. They think when the RSI is high, it's an oscillator. They should be looking to trim off and get out. But if you go and you look, I don't have it on these charts, but when the RSI indicator is in the upper zone, you're going to notice you get the biggest rallies and the strongest moves to the upside. When it's in the lower zone, below 30 or below 20, depending on what your setting is, the market has the biggest drops. So if you're trading it thinking it's an oscillator, when it's high, you should be locking in profits. When it's high, you should be moving into it, and you should be expecting bigger moves to the upside. So that is the way to look at RSI on pretty much every chart. It means it has it has good relative strength. If it has relative strength, you want to own it. That's how the band strategy works, is we own sectors that have high relative strength from multiple time frames in multiple different ways. We gauge that. The other thing is the MAs on my lines, these moving averages. A lot of you want to know what they are. They are in the book, Technical Trading Mastery, but again, they're pretty straightforward. We got the 5-day, the 20-day, and the 50-day. These are all EMAs, exponential moving averages. The green one, the thickest one, the longest one, 150-day. This is a simple moving average. So those are what I use. Very simple, straightforward. We get the long-term view, intermediate view, and then kind of the swing trading, position trading trends with the 20 and the 5-day mix there.
Momentum indicators like RSI are often misunderstood. Rather than signaling when to exit, elevated momentum frequently confirms strength. Assets showing sustained high relative strength tend to produce their largest gains during these phases. Weak momentum, by contrast, often accompanies deeper declines. In trending markets, strength attracts more strength. This perspective reframes how traders interpret overbought and oversold conditions. Combined with multiple moving averages, momentum offers a layered view of market structure, from short-term swings to long-term direction. When trends align across time frames, probabilities improve. Markets don't reward hesitation during strength, they reward alignment with prevailing momentum.
Some of you want to know about the FOMO indicator, the red indicator here, the panic selling indicator. I'm going to go over this in pretty good detail. We're just setting up everything on TradingView. So you have this whole screen and these overbought, oversold conditions, everything you'll see in TradingView with a couple clicks, the whole layout pops up and you get all of our custom indicators. But long story short, the key to trading these is when the bars are green, the 30-minute chart bars are green, it means the trend is up. The underlying trend is in favor. All you're really looking for are oversold conditions. So if you're actively trading, oversold is usually going to be a support level. It's usually a spot you could potentially add and take advantage of these pops that happen. Now, the pops aren't always just a multi-day pop, a big move. They're usually just, you can expect like a 1 or 2 day pop, just like we saw the other day. We saw it dip into the oversold territory. The next day, it had a very nice move. And that's it. Don't expect a multi-run. These are very short-term moves. The other thing to focus on is when the bars are green, forget about the FOMO. The FOMO is not something you need to worry about. When the bars are green, you're going to have FOMO hitting quite often, and that's almost like the RSI. It means there's a lot of people buying and pushing pricing higher, and that's what drives the market up. What you want to focus on is green bars and panic selling. When there's panic selling in an uptrend, those are usually standout lows. The market is starting to wash out the market. It's starting to show some fear. And usually that's when the market puts in these short-term pivot lows. So that's how we kind of look at that.
Gold and silver are entering a volatile phase marked by sharp advances and abrupt pullbacks. Gold remains relatively stable, consolidating near rising support levels, behavior consistent with healthy trend pauses. Silver, however, is displaying more extreme swings. Such volatility often emerges during late-stage advances when participation expands rapidly. These movements do not necessarily signal an end, but they do demand respect. Parabolic phases rarely move smoothly. Understanding whether these moves are driven by structural demand or speculative enthusiasm becomes critical. The difference determines whether volatility represents opportunity or warning within the broader precious metals cycle.
All right, so let's jump over to precious metals. If we take a look over at gold today, it's having a little pullback, nothing significant. It's just drifting sideways as we talked about yesterday, trying to stay above the 5-day moving average. So this is a healthy pause. If we look at the 30-minute chart, you can see here it's at a pop, a pause, a pop, a pause. 5-day moving average is kind of meandering its way up here, usually acting as kind of invisible support. And that's kind of down at the level we're at today. So we'll see if gold can find some support. Silver down 5%. Again, it is starting to get a lot of attention. It's getting a lot of volatility, big waves of buying, big waves of profit taking. And that's part of this phase. That's what happens in a bubble. That's what happens in a parabolic move. You get huge swings to the upside, huge swings to the downside, and that is just part of it. Now, let's take a look at some interesting, let's go take a look at the chart of gold, and let's look over here at a bunch of different things. So this is an interesting take on gold. The top chart is gold futures and gold volume, futures volume. The second one down is the ultra gold. So this is the 2x leverage gold ETF. And the bottom one is the inverse gold ETF, the 2x inverse. And so this gives us a good idea of the speculative traders, the more so, I say more emotional traders, because generally they're riding roller coaster rides with the moves. And what I really just want to show here is it gives you a good idea of when we're reaching a critical tipping point. So for example, over here, gold had a big run up and then it put in a peak. And then it went sideways for a very long time. But this peak was significant. We saw the leveraged ETF volume spike up and we saw a huge peak right at the same time. And also we saw the inverse ETF have a huge spike in volume just before everything went sideways. And so this gives us a good gauge of what short-term aggressive traders are doing, people chasing returns, chasing money. Usually the masses move in at the worst possible time in most cases. Now, some people obviously will buy the right ETF, but again, when something's in an uptrend, you shouldn't be buying an inverse ETF. You're not looking for it to reverse trend because all it could do is just pause and trade sideways. In fact, you just lose value because it goes down in value. If the gold doesn't drop and it goes sideways, you'll still lose money. So there's some very interesting plays that go on here. The masses usually pile in at key turning points. If we take a look at this last point here, we had a measured move right up here, right at this level, and then we went into this kind of phase where everyone just went nuts. We talked about so many people just had to get back in. If you locked in profits for a quick, we did a short 15% trade right here. We got in, we got out, and then people needed to get back in a couple days later. Well, look at the volume. There's definitely interest. If you look at the leveraged ETF to the upside, people piled in, and then a lot of people in the inverse ETF got involved as well. And so when we start to see the leveraged ETFs spike up, we got to be aware we're probably close to an intermediate peak. Now we're getting some volume. We got some volume here, but we don't have any of these huge spikes, these standout spikes on the leveraged ETFs. And that's generally the crowded play. You know, this when we get these big spikes and this super big volume, that's when we're getting emails of like, why are we in this? Or why did we take profits? I want more money. Like the FOMO just comes out of the woodwork, the emotions. So
leverage offers insight into market psychology. Volume spikes in leveraged and inverse ETFs reveal emotional extremes, moments when traders chase momentum or bet aggressively on reversals. Historically, these surges align with intermediate turning points rather than sustainable trends. When leveraged upside and downside products both see heavy activity, it suggests uncertainty and crowded positioning. Gold currently appears less speculative, while silver shows signs of mass participation. These signals don't mark exact tops, but they highlight elevated risk. Markets often pause or correct when enthusiasm peaks, not because fundamentals vanish, but because expectations have temporarily outrun reality.
That's a way to look at it. I have one here for silver as well. If we look at the silver chart, so the top chart is silver futures and the volume. The middle one is SLV. The bottom one is AGQ, which is the two leverage. It's not an inverse ETF, but you can see silver. It definitely has big volume across the board on all of them. And it's kind of dwarfed the price action, but we had a very big move up in silver. It put in a peak, and then silver went sideways for a very long time. Of course, we had a big silver spike in both of the ETFs, the regular ETF, the leveraged ETF. And here we are now getting back in big volume across the board in all of them, which is a little bit of worrying. So again, gold doesn't feel like the crowded play yet, but silver definitely is looking and feeling crowded, and everyone is talking about getting into it. Everybody's buying it. So that's just something to be aware of, and it's a unique angle to get an idea what the masses are doing, right? Futures is good stable ground. That's the base, the foundation. SLV is mass market, and then the AGQ, like the leveraged ETFs, these are the short-term emotional traders because they're trading swings, so it's very fast emotional moves. This is usually one of the final signs saying, you know, we're getting close to a peak and we're going to see something pull back. So anyways, that's it. I don't think there's a whole lot more to cover. The last two little data points here, IWC. This is the microcap sector, and then also IWM, which are the small caps. both of them are pushing up to all-time highs. And that to me is a warning sign in this type of market condition and what is going on. Simply, it's telling us people are they're moving into the riskiest plays, the fastest moving. They want to make as much money as possible. And again, there's nothing wrong with that, but when we see them moving higher, which they don't really even dent the stock market, and we see like the Magnificent Seven trading sideways and actually starting to show signs that it might be starting to break down and a lot of weakness in the big heavyweights, that is not a good sign. And usually we see, like if we go back and take a look at the IWM and we zoom back here, if we go back, IWM pushed up back over here in 2021. It made some all-time highs. Everyone got very bullish and was swinging for the fences, only to step into a very big multi-year bear market. We saw price fall on the IWM, fell somewhere around 33%. Not only that, but it went from pretty much 2022 all the way to almost all the way through 2026 or 2025. Years of real no return. You go through the roller coaster, you just wasted all those years. And so we're seeing that similar type of movement. People are really bullish, swinging for the fences. This could get rejected and move down. So when everybody's moving, we got gold already warning us, gold, silver miners, all that stuff warning us there's a problem coming, yet people are moving into the small caps thinking everything is bright and cheery. That is a red flag as well. So
perhaps the most concerning signal lies outside precious metals. Small cap and micro cap stocks are pushing higher, reflecting growing appetite for risk. Historically, this behavior often appears late in market cycles when optimism is widespread and caution fades. At the same time, leadership stocks are losing momentum. This divergence matters. When investors crowd into riskier assets while defensive signals flash elsewhere, markets become fragile. Past cycles show similar patterns preceding prolonged drawdowns. While momentum can persist longer than expected, these conditions warrant vigilance. Markets rarely ring bells at turning points, but they often whisper warnings beforehand.